Today, I am in Tarpon Springs with one of my preferred lenders that gets my deals done, JC Sommer with Cardinal Financial. So I'm going to leave it to him to tell you a little bit more about himself.
Thanks, Bill. My name is JC Sommer with Cardinal Financial. I'm a producing branch manager. I've been doing mortgages for 7 years now.
Yeah,
So I was able to be here before the craziness where rates hit the twos, and we're coming out of extreme rate highs that we haven't really seen in many years.
right.
So it's been pretty cool to be able to be a part of all that. And you get a lot of experience during that time frame.
I'm sure, especially going from 2%, thereabouts, and just the frenzy that we were in, even we saw on the real estate side of trying to get loans done and, processed and approved, denials up, down, left, and right. And then, that fast frenzy now to, a 21-year high in rates.
Yeah.
So
It's actually funny because when the rates were dropping, you had a motto: you didn't lock your rate till a week before closing.
right.
And then what you were doing is telling your customer, sorry, we can't wait any longer.
Yeah.
We have to lock to get your paperwork out for you to still buy your house. So rates were dropping and people were settling, but it's like, we have to produce paperwork. So
Yeah.
last day before you can do anything, let's lock it up. And in today's market, where rates have been rising, it's contract lock, because waiting only cost you more money. You
Right.
know, so it is a little bit of an extreme difference from one way to the other.
Yeah, polar opposite. But so today, I figured that would be a good segue to roll into different types of loans and things that we can kind of do to get loans
Sure.
approved, and different strategies, with the low inventory that we have and with the high interest rates, to try to save as much money as we can in the long run when it comes down to, financing a home.
Yeah. Well, I think part of that has to do with the relationships you build.
True.
Right?
Yeah.
I mean, a lot of the things that are happening in today's market are driven by a good relationship between your lender, your realtor, and your client.
Right.
It's open conversation season.
Mm-hmm.
What's important to the person? What are they looking for with their out-of-pocket costs? What are they looking for with their monthly payment costs? What is their financial situation going to be today versus 5 years? All those need to be taken into account when you're coming up with your strategy today to buy a home, right? First-time home buyers, move-up buyers, empty nesters with downsizing their homes, which goes right into the types of loans that we can do. With us at Cardinal Financial, I almost use the model, there's not a loan that we don't do in Florida, right? We have the standards, so we can help people with their conventional loan, great credit, little more money down. Maybe we need to do a condo, easier to get condos approved with the conventionals versus the other loans.
Okay.
So in those scenarios, conventionals are great. We offer the VA loans for the veterans, which is
Right.
one of my favorites to do. The veterans earn those benefits that they're able to use. No money down, better rates, no PMI,
Right.
a lot of the perks that go with the VA loans. So we offer those also.
Right. And PMI is primary mortgage insurance. If you don't put down 20% to the 20% to
Yeah.
80 ratio.
Yeah, if you don't put 20% down on your loan in general,
Mhm.
you're going to have private mortgage insurance somewhere. When you have a conventional loan, it's not private mortgage insurance. When you have
It just changes words, but it's insurance. Yeah.
It's insurance when you don't have 20% down. So the terms are different when you do conventional to FHA, so I don't want to confuse people that way.
Right.
But the answer is, if you don't have 20% down, you pay a little bit of insurance monthly.
Right.
The way to avoid that is, if you're a veteran, you have a VA loan, you can buy out your mortgage insurance up front, actually. So
Okay.
if you have a file that's tough to put together, DTI is not working,
Yep.
but if they have a little bit of extra cash, just enough to pay down that PMI, you could kill somebody's PMI right up front and get their ratios in line.
Oh, wow.
But they didn't put 20% down with conventional.
Conventional. Okay.
On the VA loans, it's just no PMI in general.
Just no P. Okay.
Just
none.
Zero money
Okay.
down, no PMI, lower rates. Great perks.
Fantastic. All right. Did mention conventional, VA, and then non-qualified loans and different, types of things like that. Can you elaborate on those, the
So
non-qualifieds?
Your non-qualified or your specialty loans, depends on how you want to word it, are for the clients that are not as easy to show income.
Okay.
So if a client needs to do a bank statement loan, right? Maybe they haven't filed taxes in the last couple of years.
Okay.
Them and Uncle Sam aren't on the same page yet of how they want to do it.
Mm-hmm.
So they say, okay, well, we're a little behind on tax return filings. Let's look at your bank statements.
Okay.
We can analyze your bank statements. We can actually analyze one page of your bank statement
Okay.
for 12 months and come up with an income number for you.
Oh, wow. Okay.
So you don't have to file, but there's always give and take,
Yeah.
right? So when you don't show your income as well as other people, you tend to have to put more money down.
Okay.
So you could be anywhere from 15, 20, 25, 30% down based on your credit score.
Okay.
So there is no one answer,
Right.
right? Because it's a puzzle you piece together with your client's mortgage application. So we can do bank statement loans. You can do 1099 loans.
Okay.
Oh, a cool realtor loan, 1099. Essentially, in a nutshell, right? You take their 1099 income from the previous year. You can use a ratio behind that, and we turn that into income with just one piece of paper, which was your 1099.
Oh, wow.
Yep, we utilize the ratio based on so your brokerage gives you 1099, you give it to me, I use our ratio, I come back and say, here's your new income already done.
Wow, that's great. Because that, with gig work and a lot of 1099 employees and things like that, that's probably becoming a little bit more prevalent.
Way more prevalent.
Yeah.
Also investors. You have your DSCR loan, which is your loan that is made for investors, and your qualifying factor of that is the market rent analysis you get when you order your appraisal. Oh. So you don't have to show me all your income from your 12 properties you own.
Right.
You just have to make sure that your principal and interest and your payment for your new mortgage is covered and offset by what the market rent analysis says it'll be in the area for your home. Now, there are some small things we can do in there, cool things. Factors are not always specific and credit score driven.
Right.
So not one size fits all bucket, but a scenario where we can help you buy a home without showing as much income as what other people would show.
Wow. That's great. That's good to know.
So you got bank statements, you got 1099s, you have DSCR.
Right.
The list is long.
Right.
If you really look at it, right? There's fix and flips. When you get out into the world of having a loan officer that's willing to find you the best loan that fits for you, you can really look out there and find those different programs. So you actually have fix and flip loans that are available for us to help you with. We can help you buy raw land. We can help you do construction to perm. So you have a client that says, I want to buy a house or build a house in beautiful Tarpon Springs.
Okay.
You can help them buy that lot with me.
Okay.
We can finance the lot purchase and the construction build all together in a one-time close.
Okay. And then they work with, obviously, a qualified or approved GC, and then they move forward, and then they build their house.
So they close on that lot.
Yep.
You get paid. Seller agent gets paid. Seller gets paid.
Okay.
Buyer now works with their general contractor to build their home on that lot.
Yep.
All within that one close.
And then they just do their draws just like a normal construction.
The contractor will get paid out throughout the build process. That's pretty standard right there. But what it does is allows you to open up the opportunity to say, the houses in the neighborhood are not quite meeting what I need, but there's a lot or two available. Can we make that work?
Right.
So
right, because I constantly find, one or two random lots in an area. For whatever reason, just maybe they didn't build that second lot. I've actually just listed a lot in Hudson. The person's only building one house now, not two. Yeah. So they just listed it off, and it's just, a random one-off lot.
As a perk for the realtors listening, a perk you have listing that lot is that you have a lender that does construction to perm loans. It opens up your buyer pool.
Okay.
Right? Working with the right lenders, know, opens up your buyer pool because you know about the more programs that are available to that.
Yep.
So it isn't just somebody coming in and buying raw land. You know you can help somebody build their dream home too. And those are the different products you can have.
That's pretty neat.
Which rolls us into one of my favorite programs, which is actually our renovation loans.
Okay.
So the renovation loan is cool because it basically says any home, any condition. I learned that from somebody else in our construction division, and it's a motto he uses, and I actually really like it, but any home, any condition. So you find a house in the neighborhood that is perfect, except for that house has a bad roof, bad AC, bad hot water heater, and the kitchen appliances are pretty atrocious.
Yep, and that seems to be kind of a thing now. We're starting to see a lot more of those types of properties just because of the low inventory that we have. So this is a great program. Yeah, we call it stale inventory. So, we have new inventory coming on, but there's some of these stale houses that are they're a little pricey for an investor to snatch up. Right. But we're having problems getting insurance, things like that. So that sounds like a great program.
Yeah, and so now there's a lot of variations to the renovation loan, right? So I don't want to get too in-depth. We'll talk more primary residence.
Okay.
Renovation loan. One of the easier ones is the 203K limited.
Okay.
So FHA, which means it's for primary buyers only. This is not your investor rental loan, which we have. This is your primary residence buyer.
Okay.
Went out shopping and said the roof, the AC, and the hot water heater are really the only thing holding me back from getting into the neighborhood that I love.
Right.
Bedrooms, bathrooms, pools there. cul-de-sac is there, right?
Okay.
The perks are there.
Yeah.
But they will not be able to close and financially be able to put on a new roof, hot water heater, and AC.
Right.
So we have 3 potential contractors, which is the max number on your limited FHA loan.
Okay.
And as long as the combination of all those work is less than 30 grand, it's 35. But when you start to get to the very max, there's some reserve numbers in there. There's some room for contractor bids to change.
Right.
So let's start with a generalization of 30 grand limited is what you can go with.
Okay.
Well, you get your roof for 12, 14, right? AC for 8.
Yep.
Hot water heater for 2. I don't know. I made that one up. I'm not really sure hot water heater costs, right? You're at 22 grand. You're under your 30K max. So now what you can do is say, okay, that house that was 275, we love it.
Yep.
But I don't have the money to put all into it. So we can offer 275, and JC could take my numbers and say, okay, well, I'm approved at 300.
Right.
Well, 275 purchase, 22,000 renovation.
Right.
We're under the 300 that they were pre-approved for. So now you take the total sum of the purchase price and reno.
Okay.
So for easy calculations, 275 and 25 make my life easier. 300K.
Yep.
They're only doing 3.5% down from 300K.
Okay.
So $10,000 and change gets you into a house that you just put a brand new roof, brand new AC, brand new hot water heater.
Right.
And their out-of-pocket costs are under 20 grand.
Right.
And here's what I think strategically for people is a house that needs all that work. What are you most likely going to be able to get for your buyers in today's market?
Most likely you might be able to get them to throw in the water heater. Seller credits could work. Maybe, or versus maybe even coming down a little bit, but seller credits, which is a good strategy.
So the seller credits means that we could probably say, hypothetically, it's easier said than done. You got 8 grand in seller credits on that. You went in with a full price offer on a house that needs lots of work.
Right.
But full price offer with lots of work, you got your savings in seller credits.
Yep.
We could probably get that buyer, not quoting,
yep,
because every buyer situation is different.
Exactly.
Estimated 12, 13 grand out of pocket into a $300,000 house with a brand new roof, brand new AC, brand new hot water heater. But because you got some credits to offset some of the renovation loan fees and some of the closing costs, they had to come out of their pocket their down payment at 10.
Yep.
Plus whatever they didn't get credited for closing costs.
Yep.
Could be anywhere from 2, 3, 4, 5 grand. You could get into a 300K house with all those renos done for less than 15 grand out of your pocket with the right strategy from your lender and realtor.
Right. And that's where having that partnership versus just going online and grabbing, you know, hey, look, I get it, everybody shops, and that's fine. But then when it comes down to it, and you've heard me talk about this multiple times, having that team is critical when it comes to structuring deals that are more complicated. Being able to talk to someone like JC or even a member of his team on the weekend. We find this house, we're out shopping, it's the weekend, we all have jobs. And I'm like, I need something from JC or a member of his team. He'll answer the phone.
Right.
You know, I call and say, hey, JC, can you call me at your earliest convenience? I've got something going on. And he'll pick up the phone because he knows that we're trying to make things work. You go onto your online or even your bank's not answering the phone on the weekends because your bank's closed. And I understand that.
Yeah.
There's a difference. So this is where the team comes into
you text me and say, hey, I'm out shopping with XYZ buyer.
Yeah.
And they love this house. They're thinking about this offer. What do you think this looks like?
Yeah.
Between me and my team, we're going to be able to get into the system, look at some numbers, get back with you and say, hey, that structured offer gets them to what they want. Which remember, the conversation of out-of-pocket costs, monthly total, monthly costs, and monthly payment.
Right.
Those are the conversations I have with the buyer to find out what's important. Remember, this isn't about just pre-approving you for your max pre-approval number.
Right.
The biggest misconception when people call me is, what's my max pre-approval? I don't even like that question.
Right.
Because your max pre-approval is nothing to do with what your comfort level is. I've had plenty of people, their max pre-approval is well above what their monthly payment that they're really comfortable with.
Right.
So when I come back and say your payment's $4,000, you're like, whoa, I was trying to keep it at $2,700. Well, then maybe you don't want to buy the $600,000 house that you're pre-approved for.
Right.
And you really need to have the conversation of, well, JC, help me buy a house keeping my payment at $2,800.
Right.
And my out-of-pocket costs at 40 grand or less.
Yep.
Well, then when I structure your loan, I'm not going to come to you and say it's 50 grand and your payment's $4. I didn't meet any of your goals.
Right.
And
that creates frustration for everybody.
Misunderstandings.
Yep. So that's where buyer interview, I get a little more in-depth on conversation, but this is what helps us really hone in on exactly what your goals are so that we put together the right package. And that's critical, is that early onset reduces frustration, broken hearts, disappointment, things like that.
Wasted time.
Yep, and tons of time wasted where you could have missed out on an opportunity.
Well, it's the buyers took off work to go see a house that in reality, they're not going to buy because the payment was so high that wasn't their comfort level.
Right, and
but
they didn't even realize
wasted
it.
their day off, their half day off, seeing houses that really didn't fit.
Yeah, they took time, and it gets frustrating and it gets exhausting from your part on a buyer. There is such thing as buyer fatigue.
Yeah.
So,
well, I actually look at it as, I think that's a vital conversation.
Yeah.
Realtors, one of their things is what's vital to a realtor is making sure that somebody's qualified to see homes that they're looking for.
Mm-hmm.
What's vital in my business as a lender is the customer that wants to have the conversation about what you're really looking to get done with your loan.
Right.
I'm against the whole max me out and send me on my way number.
Right.
I think relationships will matter. You got to have that good 10-minute conversation.
Yeah, absolutely.
So, yeah, I think that's big.
Some other stuff when it comes to making offers and mortgages, you hear a lot right now trying to get creative with 2-1 buy downs.
Yeah. Rate buy downs. 2-1 rate buy downs.
2-1 rate buy downs. Yeah. Can you elaborate a little bit on that?
Well, you got to figure what's right now driving everybody's conversation is the word rate.
Mm-hmm.
Everything that goes in with that word rate.
Yep.
Rate buy downs, par rates, 2-1 buy downs, temporary buy downs, permanent buy downs, all the combination of different ways to say it all.
Mm-hmm.
In a nutshell, you have what's called your temporary buy downs, like a 2-1.
Yep.
Now, the variation of a 2-1 buy down is you can also hear 1-1 buy down. You can hear of a 3-2-1 buy down. They are all the same product with different years built into them. And essentially what is happening is you are taking seller credits and you are going to put that money into an escrow account.
Okay.
The lender is going to hold that money and throw it into your payment so you pay less each month for the next 2 years and 1 year.
Okay.
Your payment is the lowest on your 2-1 buy down example.
Yep.
Month 1, year 1, because that's your 2-year drop in your interest rate.
Okay.
So hypothetically, if I was quoting you a 7.25, your first month's payment on your mortgage for your first year is based on 5.25.
Okay.
Because that's where the 2 comes from in 2-1 buy down.
Okay.
So the seller gives you credits on your transaction. The lender holds those credits into an escrow.
Okay.
And then what happens is you're paying based on a 5.25 year 1, then based on 6.25 year 2, which is where the 2-1 portion comes from your buy down.
Okay.
And then on year 3, you're in your standard payment at 7.25.
Okay.
So there, that first year, the lender is holding your money in escrow that the seller gave you, and they're kicking in the difference to meet your standard payment.
Okay.
On year 2, they're kicking in a little less.
Yep.
Because there's only a 1% rate buy down on that. And then after that, the money runs out and you're back to your standard payment.
Okay.
So your 2-1 buy down is utilizing seller credits in a very temporary aspect of lowering your payment.
Okay.
3-2-1, 2-1, 1-1.
Gotcha.
Depending on how much you get in seller credits will determine on which product you can ultimately use.
Okay. And then with that, there's going to be a point where you don't want to refi until, because do you lose your money that you bought your points down?
Perfect question. I like it. On your 2-1 buy down, it's escrow money so you don't lose it. So if you refi because rates change faster than what you've done on your 2 or 1 year buy down, then that money actually goes to a principal reduction when you do your refinance. That's a little different in the aspect of your permanent buy down. Your permanent buy down is going to require probably for you to use less of your seller credits.
Okay.
But you don't get any money back if you refi too early.
Okay.
So if the conversation goes to doing a rate buy down, you figure out if you do no rate buy down, how much your monthly payment. If you buy your rate down a little bit, how much your new monthly payment, and how many years does it take to break even?
Right.
And you don't want to refi or sell prior to that number, or else you just threw a little bit of money up front that you really didn't need to.
Didn't need to. Right.
But on the permanent buy down, if rates don't reverse course as fast as a lot of us predict, which personal opinion, somewhere in that, hopefully that 2-year range is what I'm shooting for here. No hard data facts of economics that I know besides watching, everything else everybody else watches. But if it doesn't change, then on your permanent buy down, you still get to take advantage of the better rate for as long as it takes for rates to shift.
Gotcha.
Whereas your temporary, you go back to your default higher rate and there is no more, buy down there.
Right.
So.
Perfect. That's awesome. That's great. So you can see that there's a lot of different programs that you can get into and things that can ultimately save you money, but it all comes down to having a plan and sitting down with your real estate professional, the team, your lender, and everybody kind of having that conversation and getting on that same, getting on the same playing field before we actually go out and start shopping. That's really what it boils down to.
Yeah.
So
I think that matters.
yeah. So JC, thanks. I really appreciate it, taking the time today to sit down and, explain this to me and everybody else so that we're all on the same page and everybody else can utilize this information. So until next time, I appreciate you sticking to the end. Thank you. And we'll talk to you soon.
Thank you.